Australian farmers suing the federal government. It's highly unusual, but it's happening right now. And there's possibly $100 million or more involved. And it's all about the federal government's decision to ban the live trade to Indonesia last year. Law firms representing exporters, producers and others involved in the live trade are suing under an act called Compensation for Detriment Caused by Defective Administration. In plain English, you stuffed up and now we want you to pay. Everybody's keeping stum for the moment, lawyers, plaintiffs and the government. Nobody's saying anything. But this could develop into one of the biggest agribusiness stories of the year. Now, in live trade news from the north, it's very slow at the moment with lots of cattle available, shipping issues and, of course, the last of the quota to be filled. So the Darwin quote is $1.70 for steers and $1.55 a kilo for heifers. Sale yard action last week saw a big lift in numbers, up 11% nationally, and quality for this time of year is said to be very good. But as winter descends, producers know it's a numbers and feed game and prices slumped across the board. The falling dollar will help export categories eventually, but for the moment it's all negative. That cow price would surprise many, but overall these prices are much the same as this week of last year. The key marker, the Eastern States Young Cattle Indicator, slipped 10 cents to $3.64. Incidentally, that falling dollar will, I'm told, help farmers' incomes to the tune of $190 million for every cent it drops. Lamb numbers were also up last week and quality was said to be so-so. In contrast, sheep numbers were tight and strong competition held prices reasonably firm. Now on to grains, and there's every possibility Australia is in for another bumper wheat crop. Weather concerns remain an issue, especially in Western Australia, and the crop is a long way from in the bin. But all things being equal, the wheat crop this season is likely to be over 23 million tonnes. So what prices can growers expect? I asked Luke Matthews from the Commonwealth Bank if he was a bear or a bull in relation to grain prices.
Well, over the balance of this year, I think I'd have to fall into the bear camp. And the reason for that, Kerry, is that we are seeing a recovery in global grain production in 2012, 2013, and that's largely driven by the corn market. We are seeing within the United States a significant lift in corn plantings, and most importantly, crop conditions in the United States remain very, very conducive to strong yields. And so we are expecting this production response to come through. That will help lift global inventories off their lows that we saw last year. And as a result of that, we are expecting the market to come off further over the balance of 2012.
So producers in Australia should be managing their futures very carefully?
Yeah, look, the futures market and forward pricing generally in the grains market right now is anything but a little bit dull. The prices on offer are not overly attractive, to say the least, in the grains market. It is a different story if we start to talk the oilseed market. Canola producers here in this country are facing very strong returns if they can produce a crop. But back on the grains market, it is at the moment a little bit of an environment of wait and see with forward pricing, because current markets today are probably not at levels that would induce many people to go and lock in contracts.
But they could go down even further, couldn't they?
They most certainly could, and look, our expectation is at the end of the year we'll have an Aussie dollar wheat price somewhere between 200 and 220 port, and that's driven by the fact that we expect the Aussie dollar to remain firm over the balance of this year, combined with our expectation that global grain markets are going to continue to come under pressure.
So let's see what the ASX says about the wheat price for next year. Now that's a sharp lift from last week, and although dry conditions are slowing the planting program across Australia, it's far too early to suggest any major problems, and those price spikes would have to be based on overseas factors. And there are issues overseas. Pro Farmer reports the fundamentals for wheat are at a turning point. Weather in Russia and the US has put a real spike into prices after weeks of gloom. So wheat has lifted the equivalent of about $20 a tonne, and corn went up in concert. But the soybean rocket dipped a little last week. Local cash prices have jumped as well. Wheat has risen to its highest level since August of last year, and sorghum had a nice lift also. Canola traders might be puzzled at that slide, as demand appears to be very firm, especially from Europe. Australian cotton growers would be happy if they booked their price a few weeks back. New York trade last week saw cotton fall to its lowest level in 2 years. Pundits reckon this could be the floor. Time alone will tell. So cotton is now at just above 76 cents a pound, a dump of about 50% over the past year, and sugar has firmed a fraction after several weeks on the slide. Finally to wool, which had a poor week as the market reacted to the broader equity slump and the Eurozone crisis. There's a lot of money going out of Australia and into US Treasury bonds and other safe havens like the Swiss franc and the yen. This is pushing our dollar down and is helping wool growers, well, at least a little bit. The Eastern market indicator dropped 2.9% to 1,121 cents a kilo. Pass-in rates were very high as China again dominated. And that's the Landline check on prices.